In 2008, while you were watching your retirement account collapse, someone was getting rich, not lucky, not positioned well, getting rich because of the crash, betting on your failure, profiting from the panic. And here's the part that should make your blood boil. The same institutions that caused the crisis made more money during the collapse than they did during the boom. They didn't just survive the crash. They engineered it, then they shorted it. Then they got bailed out with your tax dollars. This isn't a conspiracy theory. It's a business model, a trick so profitable, so perfectly legal that it's been repeated every decade for the past century. And it starts with a simple inversion of logic. What if the real money isn't in building things up, but in burning them down? September 2008. Lehman Brothers collapses. The stock market is hemorrhaging. Retirement accounts evaporate overnight. Millions lose their homes. But inside the offices of Goldman Sachs, champagne corks are popping. Their mortgage desk, the same desk that spent years selling toxic subprime loans to investors, has made a fortune betting against those exact same mortgages. They sold the poison. Then they bought insurance against the poison. Then they watched people die and collected the payout. Here's a number that should stop you cold. Goldman's trading desk made money on 46 out of 48 trading days in the first quarter of 2008. That's a 96% success rate in the middle of the worst financial crisis since the Great Depression. Mathematically, that's not prediction. That's insider positioning. When asked about it later, the CEO sits before Congress with a slight smile. "We were making markets," he says. Translation: yes, we bet against our own clients, and it was legal. But Goldman wasn't alone. Deutsche Bank, JP Morgan, Citigroup, all of them had traders quietly shorting the same securities they were publicly recommending. All of them made billions while the world burned. And when it was over, when the dust settled and the anger rose, not one of them went to prison. Not one. Instead, they got $16 trillion in bailouts, loans, and guarantees. Public money, your money, to save the institutions that profited from the crash they created. This wasn't a failure of regulation. It was the system working exactly as designed. Because the trick isn't just about causing crashes. It's about making crashes more profitable than the booms that precede them. And to understand how, we need to go back to the man who showed them all it could be done. London, 1929. The world is drunk on prosperity. The roaring 20s are in full swing. Stock prices climb daily. Everyone from factory workers to bankers is buying shares on borrowed money, convinced the party will never end. But in a quiet office in the city of London, a man named Clarence Hatry is running the oldest trick in finance. He's borrowing against assets that don't exist. His companies are shells. His balance sheets are fiction. But the loans are real. And when the house of cards collapses in September 1929, it sends shockwaves across the Atlantic. Within weeks, the Wall Street crash begins. Panic selling, margin calls, suicides from skyscraper windows. The Great Depression follows, a decade of breadlines, dust bowls, and collapse. But here's what the history books don't emphasize. While millions starved, a small group of financiers made fortunes. Joseph Kennedy, yes, that Kennedy, the father of the future president, had shorted the market before the crash. He walked away with millions while his countrymen lost everything. When asked how he knew to sell, he allegedly said, "When the shoeshine boy starts giving stock tips, it's time to get out." He didn't just predict the crash, he positioned for it. And when it came, he profited. The Rothschilds, the Morgans, the Warburgs, all of them had quietly shifted their wealth into cash, gold, and short positions months before the collapse. They knew. Not because they were psychic, because they understood the mechanics, because they'd helped build the machine that makes crashes inevitable and profitable. Here's the trick in its simplest form. 7 steps, repeated every decade like clockwork. Step 1. Inflate the bubble. Lend recklessly. Convince everyone the good times will last forever. Get people to borrow against inflated assets. The bigger the bubble, the better. Step 2. Quietly exit. While still publicly cheerleading the market, start selling your own positions. Move into cash. Buy insurance against the assets you just sold. In modern terms, buy credit default swaps, short the indexes, position for collapse. Step 3. Pop the bubble. It doesn't take much. Stop lending. Call in loans. Sell aggressively. Panic is contagious. Once it starts, it feeds itself. Step 4. Profit from the fall. Your shorts pay off. Your insurance pays out. Assets you want are now selling for pennies on the dollar. Step 5. Buy the wreckage. Use your profits and cash reserves to acquire real assets, land, companies, infrastructure at fire sale prices. Step 6. Get bailed out. When the crash threatens the entire system, governments step in. They don't rescue the people who lost their homes. They rescue the banks with public money, which you then use to buy more assets. Step 7. Repeat. This isn't theory. It's documented history. And it's happened in every major financial crisis of the past 100 years. The Panic of 1907, the Great Depression, the Savings and Loan Crisis, the dot-com bust, the 2008 financial crisis, the 2020 COVID crash. Every single time, the same pattern. Inflate, exit, crash, profit, consolidate, bailout. Every single time, wealth concentrates upward while everyone else loses. And every single time, we're told it was unpredictable. A black swan. A once-in-a-generation event. Except it happens every generation, like clockwork. Let's talk about how they actually do it. The mechanics behind the con. In the 1920s, it was margin lending. Banks would lend you 90% of a stock's value, letting you buy shares with just 10% down. As long as prices rose, everyone won. But when prices fell even slightly, margin calls forced selling, which pushed prices lower, which triggered more margin calls. A death spiral by design. In the 2000s, it was subprime mortgages bundled into securities. Banks lent to people who couldn't afford homes, then packaged those loans into complex instruments called CDOs, collateralized debt obligations. Think of it like this. Imagine a restaurant selling expired meat to customers, then selling insurance policies that pay out when those customers get food poisoning, then betting with other restaurants on how many customers will die. That's a CDO with a credit default swap. Banks sold these toxic packages to pension funds, insurance companies, foreign governments, all while rating agencies slapped 8-away ratings on the garbage. Safe as US Treasury bonds, they said. But here's the beautiful cruelty. The same banks creating these CDOs were simultaneously buying credit default swaps, essentially insurance policies that paid out when the CDOs failed. They were selling fire insurance on houses they were planning to burn down. John Paulson, a hedge fund manager, made $15 billion in 2007 by betting against subprime mortgages. He didn't just predict the crash. He helped select which mortgages went into the CDOs, picking the worst ones, then bet against them. Goldman Sachs created a CDO called Abacus. They let a hedge fund manager named John Paulson pick the mortgages, specifically selecting loans designed to fail. Then Goldman sold Abacus to investors while Paulson shorted it. The investors lost $1 billion. Goldman and Paulson made a fortune. When confronted, Goldman argued they were just facilitating trades, market makers, neutral parties. But you can't be neutral when you're the house and the player and the dealer, and you've marked the cards. Honduras, the 2008 crash should have ended this. The public was furious. Politicians promised reform. Occupy Wall Street filled the streets. But here's what actually happened. The 5 biggest banks before the crisis became even bigger after it. They absorbed the corpses of their failed competitors. Bank of America bought Merrill Lynch. JP Morgan took Bear Stearns and Washington Mutual. Wells Fargo swallowed Wachovia. Too big to fail became bigger and more immune. Total fines paid by banks for fraud related to the crisis, approximately $150 billion. Total profits made by those same banks during and after the crisis, over $1 trillion. Total number of executives imprisoned, 1. A single mid-level Credit Suisse banker, not a CEO, not a board member, a scapegoat. Meanwhile, 10 million Americans lost their homes, $19 trillion in household wealth evaporated. An entire generation lost faith in the system. But the banks, they came out stronger, richer, more consolidated, because the crash wasn't a bug, it was a feature. Here's where it gets really dark. In 2019, the repo market, the overnight lending system that keeps banks liquid, suddenly froze. Banks stopped trusting each other. The Federal Reserve had to inject hundreds of billions to keep the system functioning. Most people never heard about it. It didn't make headlines, but it was a 5-alarm fire in the plumbing of global finance. Then COVID hit in 2020. The stock market crashed 34% in weeks. Businesses closed. Unemployment spiked to depression-era levels. Panic everywhere. And the Federal Reserve responded with the largest monetary intervention in history. They created $4 trillion in months. They bought corporate bonds, mortgage-backed securities, even junk-rated debt. They backstopped everything. Who benefited most? The wealthy, those who owned assets. Stock portfolios recovered within months and soared to record highs. Real estate prices exploded. The richest 1% gained $4 trillion in wealth during a pandemic. Meanwhile, small businesses collapsed. Workers lost jobs, savings drained. But the markets soared because the Fed guaranteed that asset prices couldn't fall. And here's the insidious part. Every crash now triggers automatic bailouts. The system has learned that governments will always step in. So why not take bigger risks? Why not lever up higher? The profits are privatized. The losses are socialized. Heads they win. Tails you lose. Michael Burry, the investor who predicted 2008 and was played by Christian Bale in The Big Short, has been warning that the next crash will be worse. Not because of subprime mortgages, because of everything. Corporate debt, government debt, student loans, zombie companies kept alive by cheap money. The entire system is more fragile now than it was in 2008. More interconnected, more leveraged, more dependent on central bank intervention, and the fuse is already lit. Commercial real estate, right now, $2.7 trillion in property value. Office buildings sit half empty because remote work isn't going away. Loans are coming due. Banks are massively exposed. Sound familiar? Regional banks are already failing. Silicon Valley Bank, Signature Bank, First Republic, all collapsed in 2023 when depositors lost faith. The Fed stepped in, guaranteed all deposits, not just the insured ones. Another bailout, another precedent set. But the regional banks were just the warning shot. The big players, the ones who survived 2008, they're not exposed to commercial real estate. They sold those positions years ago, moved into safer assets. And now they're positioned to buy the wreckage when smaller banks collapse under the weight of bad loans. Step 1. Inflate the bubble. Check. Commercial real estate exploded for a decade. Step 2. Quietly exit. Check. Big banks reduced exposure starting in 2021. Step 3. Pop the bubble. In progress. Remote work. Plus. Rising rates. Collapsing valuations. Step 4 through 7. Coming soon. When it crashes, not if, when. The same playbook will run again, and the same people will profit. So what's the end game? Every crash consolidates wealth. Every bailout transfers public resources to private hands. Every crisis is an opportunity for those positioned correctly. After 1929, a handful of families bought America at depression prices. After 2008, private equity firms bought entire neighborhoods of foreclosed homes and turned them into rental empires. After 2020, BlackRock and Vanguard, the two largest asset managers on Earth, controlling over $20 trillion combined, expanded their holdings across every sector. They now own significant chunks of every major corporation, every bank, every media company. They don't need to crash the system anymore. They already own it. But smaller players still run the old playbook. Hedge funds shorting commercial real estate, investors betting against regional banks, traders positioned for the next liquidity crisis. Because the incentive structure is clear. If you're big enough, connected enough, informed enough, crashes are more profitable than booms. Booms are slow, competitive. Everyone's making money, so your edge is small. But crashes are fast, chaotic. Only the prepared profit. And if you helped create the crash, you know exactly when and where to position. It's not insider trading if you're not trading on information. You're trading on structure, on mechanics, on the inevitable mathematics of a debt-based system that requires perpetual growth. You're not predicting the future. You're engineering it. In 1910, a group of bankers met in secret on Jekyll Island, Georgia. J.P. Morgan's men, Rockefeller representatives, a senator. They spent 10 days drafting the legislation that would become the Federal Reserve Act. The official story: they were creating a system to prevent bank runs and financial panics. The actual result: they created a system that guarantees crashes and ensures the biggest banks survive them. Because the Federal Reserve isn't a government agency. It's a private banking cartel with a government seal. Its primary function isn't stability. It's liquidity for its member banks. When a crisis hits, the Fed's first move is always the same: protect the banks. Not depositors, not borrowers, the banks. In 2008, the Fed lent trillions at near zero interest to banks that were insolvent. Those banks turned around and bought government bonds, paying higher rates. Risk-free profit. A direct transfer from taxpayers to bank shareholders. In 2020, the Fed bought corporate bonds from companies that had spent the previous decade buying back their own stock instead of saving for emergencies, rewarding recklessness, punishing prudence. In 2023, the Fed guaranteed all deposits at failed regional banks, even the uninsured ones, over $250,000. Billionaires and corporations got full bailouts, while the FDIC insurance fund was supposedly for ordinary people. The pattern is clear. Financial institutions are allowed to gamble with unlimited leverage during booms, then get bailed out during busts. The profits are kept, the losses are distributed, and every cycle they get bolder. So what do you do with this knowledge? You could despair. Assume the game is rigged and there's no point playing. But that's what they want. Apathy is compliance. Or you could understand the game and refuse to be the victim. Here's what the insiders know. Crashes are inevitable in a debt-based monetary system. Not because of psychology, because of mathematics. When money is created as debt with interest, there's always more debt than money to repay it. Eventually, the music stops, so they position accordingly. They don't try to time the market. They stay liquid. They avoid high leverage. They buy assets that hold value through chaos: land, gold, essential infrastructure. And when everyone else is panicking, they buy the blood in the streets. You can't stop the crashes. The system is designed to produce them. But you can refuse to be the one holding the bag when the music stops. You can refuse to carry debt on depreciating assets. Refuse to believe this time is different. Refuse to trust institutions that profit from your losses. You can understand that when banks offer you easy credit during a boom, they're not doing you a favor. They're loading you with debt that will destroy you in the crash they're already planning for. You can see the pattern. The bubble inflates. The insiders exit. The crash comes. The assets transfer. The bailout arrives. Repeat. And once you see it, you can't unsee it. The commercial real estate bubble is deflating now. Student loan defaults are rising. Corporate debt is at record levels. Zombie companies, firms that can't even cover their interest payments, make up 20% of the market. The signs are there. The same signs that appeared before 1929, before 2000, before 2008. The insiders are already moving. You just can't see it yet. There's a saying in finance: never let a good crisis go to waste. It sounds cynical, but it's honest, because for the people who run this system, Crises aren't disasters. They're harvests, moments when wealth flows upward at maximum velocity, when assets change hands from the desperate to the prepared. The 2008 financial crisis was the greatest transfer of wealth in modern history. Trillions moved from the middle class to the financial elite. Home ownership rates plummeted. Corporate ownership concentrated. An entire generation was locked out of asset ownership just as asset prices were artificially inflated by central bank money printing. And it's happening again, right now, in slow motion. Student debt crisis, housing unaffordability, inflation eroding wages, commercial real estate ticking like a time bomb, over-leveraged governments. The next crash is being built in real time. The only question is, when it comes, whose side of the trade will you be on? Will you be the pension fund holding the toxic CDO, the small business owner with too much debt, the worker whose 401k evaporates overnight? Or will you be liquid, prepared, and positioned to weather what's coming? The banking trick that made crashes more profitable than booms isn't complicated. It's just invisible, hidden behind complexity, jargon, and the assumption that the people running the system want stability. They don't. Stability is boring. Stability is competitive. Stability means slow, grinding returns. Chaos is where fortunes are made, where assets transfer, where the unprepared lose everything and the positioned take it all. The goldsmiths learned this first. The banks perfected it. The hedge funds weaponized it. And now it's just the way the system works. Not hidden, not secret, just unspoken. Because if everyone understood that crashes are designed, that they're profitable, that they're inevitable by mathematical structure, people might start asking dangerous questions, like, why do we accept a monetary system that requires crashes? Why do we bail out the institutions that cause them? Why do we let private banks create public money, then profit from public disasters? These aren't radical questions. They're obvious ones. The only reason they sound radical is because you've been taught not to ask them. But you're asking now. And that's how it starts. Not with revolution, not with collapse, but with clear sight, with understanding, with the simple, undeniable recognition that the game is rigged, and it's rigged on purpose. The money in your account is a promise. The crashes are planned, the bailouts are guaranteed. And the people telling you nobody could have seen it coming are the same people who positioned for it months in advance. History doesn't repeat, it reveals. And right now, it's revealing the same pattern it's shown for 100 years. The bubble is inflating. The insiders are exiting. The crash is coming. The only question is, will you see it before it happens? Or will you be told once again that nobody could have known? Welcome to the other side of the casino table. Now you know how the house always wins. The question is, will you keep playing by their rules?